Thanks everyone for joining. I'll allow about a minute for folks to trickle in and then we'll get started. All right, hi everyone. Welcome to the Tax Facts Lunch and Learn hosted by the Wyoming Tax Facts and the Equality State Policy Center. My name is Marissa Carpio. I'm the Policy Director of the Equality State Policy Center, not of Wyoming Tax Facts. ESPC is an independent voice in Wyoming advocating for fair elections and transparent government for all of Wyoming's communities. Today we'll be talking about Wyoming's reserves and investments and how they impact Wyoming's fiscal future. For this webinar, please use the Q&A feature to ask the speakers any questions as they arise. We'll get to questions along the way. We may run short of time, so make sure you put those questions in the Q&A as soon as you have them. And with that, I'll pass it along to Sue Summers to get us started.
Thanks, Marissa, the Equality State Policy Center and the Wyoming Community Foundation for making these webinars possible. And thanks to everyone attending today. I'm Sue Summers, co-founder of Wyoming Tax Facts. Learn more about us at wyomingtaxfacts.org. Our first presenter is Patrick Fleming, Chief Investment Officer for the Wyoming State Treasurer's Office. He's responsible for managing the state's non-pension assets. Mr. Fleming spent 3 decades specializing in domestic and global bond markets, equities, and commodities. He's worked in Tokyo, Hong Kong, London, New York, and elsewhere, and he has shared his knowledge with MBA and undergraduate students at the University of Wyoming. He's going to set the stage for us with facts about our state's reserve funds. Our second presenter will be Representative Steve Harshman, who we hope will join us as he's able. Many of you know Steve since he's served in the Wyoming House of Representatives for District 37 in Natrona County since 2003 and is a former Speaker of the House. He's got extensive experience on the Joint Revenue and Appropriations Committees. Steve has been a leading voice on fiscal policy for over 2 decades in the state legislature. He's a lifelong educator and holds a Bachelor of Science in Education from Black Hills State University and a Master of Education from Oregon State University. Steve will help us understand decisions anticipated by the legislature this year that could impact the state's reserves and, by extension, its citizens. Patrick, please get us rolling.
Oh, thank you, Sue. Thank you, Marissa. Can you hear me all? Is that good? Well, thank you, everyone. My name is Patrick Fleming. I'm CIO for the State Treasurer's Office here in Cheyenne. As Sue mentioned, we manage approximately $31 billion now in assets. And I'm going to start off with that number because many people throughout the state look at this and go, oh my gosh, $31 billion, that's a tremendous amount of money. Do we need $31 billion to run the state? And so I'm going to start off a little bit on that. It's just understanding that $31 billion is split up amongst many different funds. And these are the bulk of them, but we even have more than that. There's other funds that we help manage that aren't on here that are smaller, but these are the big ones. And so the one thing that I want to highlight is if you can see this with the Permanent Mill Trust Fund, as of June, I'm sorry, this is an August date. As of August, it's 12.1 billion. So the permanent funds, they're in violet, and these are the funds that you cannot spend without a constitutional change. But the $12 million, the money that we earn from this, is used to help with the state's funding. It pays the bills, basically. So what we're talking about is of the general fund, we provide almost a third of that income on an annual basis. So the income that we make from this fund helps so all of you do not pay state income tax. And so that's what the founding legislators wanted to do years ago is saying, okay, let's start some of these permanent funds that we can use to fund the state's wants and needs. So if you go down it, there's been I think a conversation or people have said it's like, well, this is too much money. Let's distribute some of this money or use it in a different way. Well, when you look at it, you could see these different funds, but all of these, just about all of the funds are already spoken for various constituents and people and agencies throughout the state. So as I mentioned with the Permanent Mineral Trust, that's the money that the state runs its services on. You can go down and look at some of these other ones, the Hathaway Scholarship, 831 million there. That provides scholarships for the students of Wyoming. Common School, that's a big one. That provides K through 12 education. So we hopefully don't have to pay additional money to fund our wonderful school systems throughout the state. Workers' compensation, 2.7 billion. Those are monies to provide for the workers' comp for entities throughout the state. So if anyone gets hurt, we have the ability to provide services for those individuals. Pool A is just a larger pool for various agencies, Wyoming Wildlife Natural Resource Trust, Cultural Trust Fund, et cetera. These funds provide income for those entities. State agency pool, that's a big one, 6.3, but that is comprised of, I don't know, approximately 400 odd agencies throughout Wyoming. So that the income produced from these funds allows working capital for these various agencies that we have entities throughout the state to operate. Now, the LSRA, Legislative Stability Reserve Account, 1.6. That is one that's called kind of the rainy day fund. So we have that money set aside in case we have unforeseen issues that come about, whether, large fires or COVID or anything like that. So that money is used for emergencies. And so really the only one of these funds that are not earmarked for specific instances would be the LISRA. And with that, as you all know, there's unforeseen issues that could happen. And I'm not here to say that 1.6 is the right number or 2.6 or, you know, 0.6. It's these are the funds that we have, and that's what the legislature uses. But it's also used to guarantee certain loans and so forth, which hopefully Representative Harshman can talk about it at when I'm done with this at the later part of the presentation. So the point of this conversation is just to show, when we talk about 30.529 billion dollars, that it's not comprised of just this chunk of change that is sitting there and we use whatever we want to use with it. Each one of these funds have its special purpose and needs and constituents that for the people of Wyoming. And as I mentioned, if we don't have this money, then we're going to have to make up for it. It's either you cut services or you start paying taxes. And I know none of us, I'm a third generation Wyomingite. I don't want to pay taxes, and I don't think we should, and nor do I think anyone else. So hopefully, by growing these funds, we're going to enable the state to be self-sufficient and not rely as much on other income that could be fleeting. And so that leads me to the next issue that we have, which is what are some of the future problems that the state and the people of Wyoming face? Well, one of the big ones is our mineral income. So as all of you know, we've been very fortunate to have largest coal reserves in the United States and more BTUs in Saudi Arabia. But the problem is that coal is thought to be problematic from other states. And it's not that we're not producing it. It's just that our customers are not buying it. So they are reducing the amount of purchases of coal for their coal-fired power plants and instead substituting that for natural gas-fired plants. So as you can see, the coal production has been on a precipitous decline from the late aughts and early 2009-10, and from projections with the CREG, the Consensus Revenue Estimating Group, and also various Wyoming professors who study this extensively. This is Professor Rod Godbee's chart that was also presented to Craig, showing that the decline that we have with our coal productions. And there's various times when you see these dips, but when we have these dips, it impacts all of the things that I just mentioned, K through 12s, our jobs, the state, et cetera. So this is a situation that I don't see any way that this doesn't continue to decline, not from what we can produce, but from what our customer base is buying. They are not buying as much coal, and many have already talked about shutting down their coal-fired plants, which will cause us to decline even more so. Well, here's another one. So this highlights the coal lease bonuses. So this is the amount of money when the coal producers are buying leases in the state to be able to produce coal. Well, as you can see, no one is doing this. They know that their production is going to decline and they're not purchasing the coal. The problem with this is, as you can see, this has provided monies for K through 12 capital construction, 2.4 billion. So if we don't have this money coming in from the leases or the production, how are we going to fund it? And that's one of the big issues that we have. So what are we talking about when we're saying how much money will we have forecasted right now? So if you see the 2030 coal, gas, oil production scenarios, this again is from Professor Godbee and also Craig, looking at our Consensus Revenue Estimating Group forecasts. We're looking at a total reduction of approximately $700 million over the next 5 years. The bright spot is potentially if we could see oil rebound or go higher, then that a 25% increase in oil would bring us up another 120 million odd. But that still has us somewhere between 500 to 600 million in lost revenue. So where are we going to get that money? That is the big issue that I see that the state faces over the next 5 to 10 years. And as we know, Wyoming's mineral income is going down. There's not an alternative that anyone at University of Wyoming, the state, has seen that could potentially increase that mineral income with the outlook for coal, because coal is a driving factor here. So the other area that I want to mention is inflation. So if we do not have the same type of revenue coming in from minerals, how are we going to inflation-proof the portfolio? And what I mean by that is, when you're looking at your spending, real interest rate returns, let's just say, for example, you are earning $100 a day, a month, a week, whatever it is. And that income is static, stays the same for the next 10 years. So $100 now you're going to get paid that same amount in the future. Well, if inflation is running at 2.5% or 5% or 10% or what have you, that erodes your purchasing power. So you need to be able to get a higher return, a higher salary, any way you want to look at it, to offset the impacts of inflation, to just to stay the same. So if on a real basis, inflation adjusted, if you are getting an increase of 2.5% in your salary per year, and inflation is 2.5%, then you're the same. You're not better off, you're not worse off. You're just able to keep that purchasing power that you've had on a real basis. So when you look at it, inflation is averaged 2.6% over the last 20 years. And the permanent mineral trust funds return have been 6.3%. So on a real basis, the real rate of return has been 3.7. So that's 6.3% return from the investments minus inflation gives us a 3.7%. So that's great, right? So we're doing well. But if our spending policies are above 3.7 and the PMTF and Common School are at 5%, then we have a difference there of that 1.3 that needs to be made up. Now, historically, we have inflation proofed these funds, these distributions because of the mineral income. Now, my big question is, will that continue? And from the previous slides, we know that the coal production is not going to, but potentially could we get those type of funds coming in from other areas? And as I said, the big one that we have is we're trying to maximize the returns on the fund. So that's one of the big ones. But will this continue? Here's another issue that has me a little bit nervous is I used 2.6% for the last 20 years, right? For the average inflation. But if you look at average inflation since 1991, it's been abnormally low, historically low. And that's primarily been because of the fall of the bamboo curtain, they call it, the amount of labor supply that's come into the market, the North American Free Trade Agreement, the WTO, all of these things have combined to help global trade. So globalization has really caused inflation to fall. Cost of goods and services have declined, et cetera. But now, instead of looking at offshoring, many countries are saying, hey, well, we can't rely on what's going to happen outside. We have to be dependent internally on our own production. And so with that, it's costly to move onshore, and typically it's more expensive. You're not using cheap labor in Asia, et cetera, which US labor is more expensive. The other aspect that people don't really talk about would be global conflicts. Over this period, it's been a very benign time for global conflicts, and that's that chart down below on the next one that you see is we haven't had a lot of wars, which has been wonderful. But as all of you know, recently we've seen more and more conflicts surface, and so will we potentially see more conflicts over the next 20 than the last 20? And I'm not here to forecast what inflation is going to be here with the next 20. I just want to highlight to all of you some of the issues that we may face going forward and what we've looked at in the past, and will that stay the same in go in the future? So if you were just looking on a historical standpoint, you'd say, well, it's unlikely that you're going to see the same type of inflation over the next 20 because of those factors that were prevalent from 1991 have been either 100% or partially reversed. And then we have potential for wars as well. So that leads us to what about our funds and the people and our kids and our grandkids? Will we have the funding? I'm sorry, Marissa, did you want to interrupt?
I just had one question before we move on to this next slide, if it's okay, from the audience.
Sure.
Sorry to cut in. One of the questions asked was, my understanding is that our permanent funds are only allowed to pay out income, interest, and dividends, but not capital gains like a traditional endowment can. Is that correct?
Yes, but let me clarify that. We pay out realized capital gains. We do not pay out unrealized. And that is one of the problems. So as we've moved from more just pure bonds, which pay interest income, as all of you know. It's just like a loan, and gone into different asset classes. The structure that they put forth years and years and years ago was to pay interest income, dividends, realized capital gains. But the unrealized portion, we can't. So in this instance, it's a problem for us, because just think if you had $100 invested in Apple stock and Apple doubled. So now you have $200. You're thinking, oh, this is great. Well, I'm going to use that $100 that I just had in a unrealized gain in Apple. And since I have $200 out there, I'm going to just go out to dinner and have a dinner. We can't do that because we can't spend that money. We can't go out and say, well, it's really there, but we can't spend it because who knows, maybe the market will go down. So that's a problem from our spending policies, because we can only distribute money that's in the bank. And that's one of the handcuffs that we have.
Great, thank you, and thanks for letting me cut in.
Sure, anytime. So you tell me if you want to cut in anytime we can, I'll do whatever is easiest for everyone. So the next one is speaking of intergenerational equity. So part of the reasons the permanent funds were set up is, and thank God they were, because we're in such a better situation now than if they weren't, is when they set these funds up, they're saying, okay, well, if we're going to extract this coal, oil, and natural gas from the lands of Wyoming, and we're going to use that money to spend on our needs that we have, are we doing a disservice to the current generation versus future generations? And so that's what intergenerational equity is that theoretically what you want to do is money that's spent today should be the same on a inflation adjusted basis for our kids and our grandkids. And so that's something that we had set up originally. And I just want to highlight some of the issues that I just put forth that could cause this fairness, if you will, um, to be put to the test. So, what is intergenerational equity? It's the egalitarian equity between present and future generations. As I said, make everything equal, right? So aims to ensure that citizens of tomorrow have the same opportunity as today. So how do you try to strive and find out whether it's going to be the same or not? Well, the big ones are the sustainable spending policy. If we had a 20% spending policy instead of 5, that would be massively problematic because current generations would be receiving much more. Investment returns after inflation, which, as I mentioned before, is super important, to make sure that we are having a positive real rate of return, and not have that loss of income that I was mentioning before. And then the contribution policy, which is primarily in the severance. Is that going to stay the same? So what our consultants have done is they've looked at the outlook that we have currently and used all the information that we know, taking our current 5% spending policy, looking at inflation at 2.5%, I think they used, and using the mineral income severance that we have forecasted in Craig, and just straight lining that decline and showing what's going to happen to our future income unless something dramatically different changes, which we can't see how that's going to change. And what happens to the intergenerational equity between now and our forward generation. So as you can see from this, the green line is showing that it's okay for the next few years. But as we see that mineral decline continue, then we are clearly going to be doing a disservice to our future generations. And so that is something that we look at. And oh, by the way, this is an inflation at 2.5%. God forbid what happens is inflation at 5, then it's even, much, much worse. So these are some of the things that we hopefully our legislators need to look at and work on as we go through this process, and understanding that if we spend money now and we don't have the income for the future generations, with loss of mineral, inflation, what have you, our future generations are going to be at a disservice. So this is the permanent mineral trust fund, but it's the same with common school. With common school, we have a little bit more income focus and more money coming in initially, so it doesn't really flip over for 12 years. So we have time, but there is definitely a problem that needs to be fixed. And one of the things that the treasurer has been focusing on is looking at a generational fund. Many of the legislators have been working on this as well, to say, well, can we take some of the income that we have now and put this into an investment that will return a higher yield by not distributing? There is definitely this opportunity. Other countries, other states have done something similar to try and ameliorate this difference between what we need to have the same for all generations on a forward basis. So these are some of the things that this legislature and future legislators need to look at to try and help out. So yes, we have some issues facing us, but I do think that with our ability to invest in higher yielding securities, as long as we don't distribute those, we can take care of this difference. Oil and gas and coal, we can't control it. But if we can continue to grow our funds to distribute more income to the state, then that's something that is very profitable for us. I don't, Marissa, Sue, I could comment briefly on the performance of what we've done and some of the things we're doing internally to try and get additional dollars to the state, if you'd care.
That sounds good.
Yeah, I think that would be great.
Okay, so when we look at the state's performance, it's like, well, how have we done? So 15, in 2015, 10 years ago, this is where we were. So these are comparable sovereign wealth funds. So what we're talking about, we're considered a sovereign wealth fund. And a pension fund would be Wyoming Retirement. That takes care of the pensioners of Wyoming. That's not anything that we do. That's Sam Masudi and that crew that's doing a fabulous job over at the WRS. But here, when we came through, you can see we weren't doing very well. We're in the bottom quartile on a 1, 3, 5, and 10-year basis. So these are things that when I joined, this is something that Treasurer Gordon at the time, now Governor Gordon, and Treasurer Meyer, we've been focusing on. What do we do to improve the returns? Because if we can increase these returns, that's more money for the state. So how have we done? So here's the 2024 rankings as of June 30. Well, we moved from the bottom quartile to the top quartile on a 1-year return. We're number 1 on a 3-year return, top quartile on 5, and we're median now on a 10, because that's going to take some time. So hopefully the next CIO that comes along will be able to take it over the next 10 years. And our goal is to be in the top quartile in the 1, 3, 5, and 10 years. So why is this so important? Well, this is really important because it allows us to get more money into the state. So how are we able to do this? Well, a couple things. One, we changed our focus We were predominantly just income focused, as I mentioned before. We had a lot of bonds, and we didn't go into other alternative assets like equities and private equity, all kinds of different things that are in the portfolio now that have a higher return and a higher risk adjusted return, which is our number one mandate. But this has helped us to produce additional income. Also, we have 11 people now in the treasurer's office on the investment staff. When I started, I was one person managing $19 billion. That is just crazy. So we are saying there's no way that we can optimize these returns. And so by doing internal investments, about a third of the state's portfolio now is managed internally. We're building out this ability to manage these funds internally and create additional dollars to the state. Well, here's the structure is really important that we've put forth, and it's very, very important that it continues to go on. Because what we're showing here is what we've been able to accomplish back 10 years ago. The little red circle under the 10 years where it shows the 0.3 on the bottom side of the comparative performance. So that was a return above the index. It's called alpha. So what is alpha? Alpha is if you had $100 invested in the S&P and the S&P was up 10%, but you produced 11%, that 1% difference or 100 basis points difference is called alpha. And that's our number one focus is to produce alpha. So back then, that alpha equated to $54 million. Last year, if you look at that 1 year performance, we produced 1.4 or 140 basis points, 1.4%. And that alpha, 30 billion times 1.4 is $420 million. That's 420 million additional dollars that we can use to fund the state and its programs, to grow the fund, to enable it to have higher distributions in the future. And so these are the things that are really important. And one thing that I just am going to highlight, and hopefully we're going to speak to the legislators and show, but the system and what we're doing now, the continuity of this is extremely important. Because as soon as we start mandating different things to our investment staff, then historically things have not gone well. And I can just show you. Alaska. You see Alaska, the 10-year return, they're number one. The 5-year return, they're number two. And then you look at the 3-year return, they're 1, 2, 3, 4, 5, 6. And on the 1-year return, they're 11. So what happened? How did Alaska go from just doing great to not performing so well? Well, their structure was just doing great. They had some wonderful people running things. And then they changed. The legislature and the governor changed things. They started dictating what the fund should invest in, how they do it, what the distributions would be, et cetera. It created problems. The same thing has happened with North Dakota. North Dakota was mandated that they had to invest a certain amount into investments within the state. That has gone down. Those investments have not performed the same. New Mexico, same story. They're just in the process now of selling off those assets they were mandated to invest in New Mexico because of the underperformance of those funds. So as soon as things like this change, and if the legislature mandates some of the things that we can and cannot do, then I'm not going to be here to see it, but I will promise you it is rarely worked out. And it's not only internally, but the same thing with yeah, Norway. Norway's one of the largest sovereign wealth funds in the world. They had terrible returns because of government mandated policies. So these are all of the things that we've had. And I just want to highlight right now the working relationship that we have with the State Loan Investment Board, our 5 elected officials, and the legislators. is wonderful. That's one of the reasons why we have the investment funds committee to help with asset allocation. We have wonderful staff, our back office and middle office to enable us to do these investments. There's so many different things that they have us do that really has helped us out. That's not the case with these different funds that you see. I meet with these individuals, the CIOs from these different funds on a quarterly basis, and we talk about the problems that we have. And there's not that togetherness, that working relationship that we've enjoyed over the last 10 years. There's this, kind of fighting between different groups in many of these different states that causes the returns to diminish. And if we don't have the returns from our funds, if we have less income coming from our minerals, it's a problem. And those are some of the issues that all of you that are listening um, will need to face if we have loss of income, because we'll have to either raise taxes or cut services. There's not really a in between. So with that, I'll stand and answer any questions, but I just kind of wanted to highlight that, there's many different things that we face, but we have this tremendous opportunity. Hopefully, that the legislature will enable us to do some of these things that I talked about. Generational fund in particular, that will help with some of the loss in income that we're forecasting to have. And hopefully we can continue on to be better performers for all of you.
Thanks, Patrick. Marissa, do you see Steve joining at all? I don't see him in the participant list.
I do not see him in the participant list. Likely something came up, so it doesn't look like we'll have him today, unfortunately. But if he sends along some information, we'll make sure to put it in the recap and on our website.
Great, great. Well, Patrick, what you were just talking about makes me, excuse me, really want to ask you about House Bill 80, if you've taken any looks at that. We've had participants and other folks, and thank you for that link, Marissa, asking us about reserves and how they would be affected by this bill, which touches on what you were just talking about, where um, electeds want to shape investment policy around political leanings. At least that's how I would describe it. Any thoughts about? I noticed that there's no fiscal note that can estimate the impact of this.
I am not familiar with House Bill 80. I have not read it. But yes, if you could tell me what the political leanings could be, I could mention some of the issues that other states have faced when that happens.
Okay, well, this bill, it's about a lot of things, but the thing that sticks out the most is that it adds a new statute that's about investment of state funds, consideration of only financial purposes, and then it says that uh, that it defines. It says that you can only invest in things for financial purposes, and then it defines financial as not including any action taken to further social, political, or ideological interests. So this is an anti-ESG, anti-environment, social governance. Yes. This is
Sue.
against ESG.
Yeah, that is something that we require now. And we have an investment policy statement, IPS. And that's really our Bible for our investment Bible. We have to follow that to the T. And so any of our managers that we give money to, that if they are looking at an investment and their number one criteria has to be highest risk adjusted return. If they're looking at it and go, well, we're not going to invest in coal because we don't like coal or whatever. We won't invest with them. That's something that we do not do. All we care about is the highest risk-adjusted return. So that's something that's already in place now. Our 5 elected officials have put forth a very strong statement. The treasurer is adamant about we will never give money to somebody if they're investing under this ESG criteria, because there's all kinds of opportunities out there. So if I'm talking to a manager and they say, well, we don't really we don't like refineries, so we're not going to invest in a refinery. And I say, okay, you have an opportunity to buy a refinery at 10 cents on the dollar. It's going to return 35% annually. Would you buy it? And then say, well, no, because we don't buy refiners. It's idiotic. No, we'd say, no, you're not for us. Go to California or somewhere else. That's not what we do. So
But
all
is the main criteria, though, it's um, benefit to the fund? Like, does it do what it needs to do, or is it what comes first? Is it a good investment, or is it a appropriate, politically palatable investment?
The political side of it is, we don't look at it. We look at, is this a great investment for the state and the people of Wyoming? So we don't really care what they're doing now. Are they building cluster bombs or something like that? There's certain things that we can invest in. There's many different countries we can invest in. We can't invest in Russia, things like that. There's those types of investments that are excluded. But no, any investment that we have, we make sure that it fulfills that it is the highest risk adjusted return. Now there's certain instances, for instance, like a private equity, their investments, we're locked into this investment for 12 years. And so there'll be many private equity funds that don't invest in E&P companies, exploration and production companies, because they don't know what the outlook is going to be in 12 years. It's not that they are anti-ESG or whatever, but that's not really in their bailiwick. That's not in their wheelhouse of where their expertise lies. So there are many investments that they exclude from investing in, not because of any ESG policy. It's just, it doesn't fit in their category. Cryptocurrencies. It's like, well, the managers could be 100% invested in crypto, but they wouldn't invest in it because we don't know 12 years down the road what it's going to look like. Now, there's other areas, for instance, like E&P companies. We're massively long E&P companies. We invested in a pipeline in Wyoming. If there's a wonderful opportunity in Wyoming, we will take advantage of it. But in a public equity, that is we can sell tomorrow. So if there was, kind of Biden administration has put on drilling moratoriums or what have you, if something happened in 5 years from now or what have you, I assume that would not happen over the next 4. We'd have the ability to sell that asset the next day. We're not locked into it for 12 years. So there's those types of issues that we'd have, but there's nothing right now that we don't already have in place in our IPS that
Okay,
makes
well,
sure that doesn't happen.
I guess, and I might be misinterpreting House Bill 80, but it looks like it gets very specific about what you can and can't hold or invest in. And most of the specifics are surrounding certain political issues. And to me, it just looks like it ties your hands. Um,
Well,
uh,
let me if it gets very prescriptive, because for instance, previously there was a bill that said that we cannot invest in any company that has an ESG statement, for instance.
mhm.
So of the S&P 500 largest capitalized companies in the United States, 494 of them have an ESG statement. So just because they have a statement doesn't mean, so if we had that, we're out of business. We'd be investing in T-bills. So, there's a certain thing that if you get too prescriptive on it and saying, okay, any company that has a statement, the state of Wyoming cannot do business with, well, United Airlines would not be able to fly into the state of Wyoming. All of you could not buy any Microsoft products just because, well, Peabody Coal, pull up Peabody Coal's ESG statement. They have an ESG statement, largest coal producer in the state of Wyoming. They have an ESG statement. It doesn't mean they're anti-energy or what have you. Just because you have a statement doesn't mean that. So if you become too prescriptive, then absolutely, there is a major, major issue. If we keep to what we already have in place, then that continuity that I referred to stays the same.
Marissa, we've got a lot of questions. Have you been able to go through and pick some?
I have, and I thank you for the conversation on HB 80. We got a couple of questions and I've been contacted about it. I think the concern is if having a statement or a vision statement on an investor's website would prohibit Wyoming from investing in that company. And I think that's where the concern comes from what I've heard. So thank you for clarifying, Patrick and Sue. I have a question here. Patrick, I know many of our counties are interested in having additional investment options. Can you talk about the pros and the cons of authorizing this?
Sure. So one of the things that we're working on now, it's called WyoStar 3. So WyoStar 1 is a money market fund. WyoStar 2 is a corporate bond fund that enables local entities to invest in corp bonds that are issued by investment grade corporations. And now the third one is equities. And I think initially what the thought process would be is to invest in US equities alone right now. So right now, the large cap US equity market, that's the S&P 500 would be the index. 80% of managers do not beat that index. And then it's less than 1% that the ones that do beat the index can do it for 3 years in a row. So when you're looking at your US equity investments, it's extremely difficult to find someone who can consistently beat the S&P 500 index. If one, they can't use leverage, they can't invest outside of those 500 companies, et cetera. And so what we do is we just index it. And it costs us between 2 to 3 basis points. Again, 100 basis points are in 1%. So 2 to 3 basis points. It's nothing to just get the index return. So I think it would be a wonderful opportunity for our local entities to be able to invest in equities, but not to do single stocks, because this is where there's a lot of problems with individuals who sell certain things like annuities that have a very high rate, commission rates and so forth, to people that don't have the expertise to do it. So if the entities want to have that exposure, it's very easy for them to get it. And what we could do is buy an indexed fund that they get you could get all 500 stocks in the S&P 500 with, a couple $100 investment. And so it's a wonderful opportunity to do it, but then also you don't want them day trading. You want to have parameters put around this. So in the SLIB, back to that IPS that I referred to before, section 21 in the IPS, it's on the Treasurer's website. The 5 elected officials typically will put together a criteria of things that would allow these funds to invest in. And I would be a big proponent for allowing local entities to buy S&P 500 ETFs, they're called, that have a very low expense ratio and have a longer holding period so they don't come in and out of them. And I think that would be a wonderful opportunity for local entities to do so if their board approves it and so forth.
Thank you. And that kind of ties into another question. As you've been talking about SLIB, and I'm about to drop the link to the state loans and investment board. The question was, how often is the IPS revisited by those 5 electeds? And I'm assuming most of the time that would be in those SLIB meetings.
Correct. So every year we always there will be various things that we address, change them, clean them up, and so forth. And it's the first Thursday in June that we do that. So we first have our investment funds committee to look at our asset allocation. So we do that on an annual basis. We'll then have a joint meeting between our investment funds committee and the state loan investment board to go over these issues. And then we'll propose the changes to the IPS in that June meeting. And that's a process that we've done on an annual basis. Many different funds, they do it once every 3 or 4 years or longer. We feel that as we're growing and trying to get better returns, that 1 year is better. And it doesn't mean we have to make changes, but every year that I've been part of this for the last 10 odd years, we've made a change. So.
Thank you. And I also dropped in the information for the first June meeting in 2025, which you can find on the website. I believe it is streamed live, but everyone should attend too if that's something they're interested in.
And I just got a call from Steve Harshman. He had a death in the family, so
No.
that's why we don't have him today. We'll find another topic that he can tackle in the future.
Yeah, he would be able to definitely talk about House Bill 80 much better than I could. I can give
Well,
you
you've got the
overview.
principles down, though. I mean, and the concepts, and you also know that anytime we change, we kind of jigger things in the reserves, and how much we spend, and whether how successful those reserves are, that changes the picture for the well-being of the state.
Absolutely. Yeah, and that's the one thing that I just want to caution. I've seen it happen over and over and over again. As soon as the legislature starts to dictate what we can and cannot invest in, that's usually a slippery slope down and usually leads to lower returns.
I can't not point out that in the language of House Bill 80, it talks about financial actions that it forbids decision making based on social, political, or ideological interests. And then it goes on to apply ideological interests to the decision making about investments. So that's my take. Now,
A little bit of an oxymoron.
yeah, it's a
Yeah,
little, I think it's a little much.
yeah, dictating those. There was a bill last year also that said that if we ever invest in a company that has has furthered ESG or anything like that, then the individuals would be liable for 3 times their annual salary. That's another one that was floated where so every state loan investment board, the 5 elected officials would have a liability. Every one of our managers would have a liability of the funds that we manage, the fees that they get. There's not one manager out there that would ever manage money for the state of Wyoming under that criteria. So again, Sue, when you see these types of things, when they start dictating what's going to happen and then impose a penalty upon it, it's a very slippery slope. That one is not even slippery. It would be an immediate, well, we could only invest in US Treasuries. That's all we'd be able to invest in.
Well, and given that that we already want to provide property tax refunds and those kinds of, and the Citizens Initiative is coming up in the 26 election, I guess. We're trying to give more tax breaks to our citizens. And if we want to do that, harming our investments sounds like a really bad idea.
Well, as we mentioned that if we don't have the income, then you either cut services or what have you, or raise taxes. You could take the money that we have um, and spend it, but then we're not going to have income to produce
Mhm.
the funds needed to run the government. There's not a free lunch. There's
Well,
there's
and
nothing
I'm
out there.
I'm one of those older people who make up the bulk of the population, and I'm kind of hoping there'll be senior services when I need them, you know? Marissa, what else have you got? Because I know we're really short on time now. I know
Yeah,
you've got questions.
yeah, I have another one that relates to mandates in investing. This question is, given the size of our sovereign wealth funds, couldn't we do more to try to have more of that money managed in state? We're sending close to $150 million in fees to money managers out of state. Can't we try to capture some of those fees and build a financial services industry here in Wyoming? My my gut is that relates to your conversation about North Dakota and New Mexico and the pitfalls that they experience, but I'd love to hear your answer on this one.
Sure, Marissa. Well, that is exactly what we did. As I mentioned before, I was one person managing the 19 billion. So I went to the legislature and I just said, this is not, we can't do this and maximize the returns. So we had a deal that we would manage the money internally and we would cut those fees. So those fees have been cut significantly by managing the money internally. And by doing so, we had to produce alpha, as I was saying. So that is the big thing, that if we're going to do this, you want to do it internally, which we've done. We have 3 positions that we're going to ask for this year to continue with that internal production. But that's how we produce the alpha. Now, outside of our group, are there other people that have the ability to manage it? Well, our our statutes say, should have a 3-year track record that shows consistent alpha in these subsectors that we do. And there's very few Wyoming domiciled funds that have a record only investing in these securities with those type of returns. Because we'll look at any entity that has it, but you can't be sitting there and say, well, I'm a I don't know, financial advisor and I have money with equities and international equities and MLPs and stuff like that. You have to actually have a business. I mean, I've done this. I've run businesses that manage money for funds, and you have to be a specialized, focused investment on all of these different sectors that we have. We have international equity, U.S. equity, U.S. fixed income. We have EMD, private equity, there's all kinds of these different opportunities, but you can't just sit there and go, well, I have a hunch, bet a bunch that I think I can do this. No, you have to have a proven track record to show you can do it. Otherwise, we're just giving money away and hoping that somebody will be able to do it. But if you can prove that you're as good or better than the funds that we have, it's no different from all of our funds. I get 15 emails a day. Oh, I have this fund in, Santa Monica, California, and I can do this and this and this. I'm like, well, great. Show me your performance that you can do this year in and year out. And so, we have a consultant that takes all the funds. We have all kinds of data sets that reviews the funds. And, as I said, this is an extremely, extremely hard business to produce alpha in. It is difficult. And not only doing it one year, but do it in 3 years. And not only do produce the alpha, but then to be in the top quartile of all the funds in the world that are doing it. So, yes, we have outside fees to the other people, but look at the alpha that we're doing. So just to put in perspective, if we indexed the fund, where does that 420 come from? If we index the fund into the S&P 500, and it's called the Bloomberg Barclay Aggregate, that would be an indexed fund. We would be $420 million less off if we did that. That's what I'm referring to as an index. So are there people out there that can do it? Then gosh, show us the track record, proven track record that you have under the the regulations that we have, because otherwise I could just sit there and go, hey, my brother thinks he can beat the index.
Hey,
Hey,
Patrick, how much longer does the state have you shepherding these things?
I'm retiring at the end of June.
Dang. Well, I hope you've been training up your folks.
Oh, I have a wonderful staff. That 420 million, that's why, is because of the staff. The treasurer, the deputy treasurer, she's awesome. Kurt's great. The stuff that, any boss that you have, you'll always have things that you disagree on or whatever. But Kurt and I, we are 100% aligned into being the best top quartile manager in the world. And we've moved in that direction. The things that we're focusing on is really good. Our investment staff, I don't know, 3 or 4 PhDs now. Um, you know, People who've managed money, all different areas. To bring them into Cheyenne, Wyoming, to do this is a hard pull. But we have a wonderful, wonderful staff. And then these younger people that we're bringing from the University of Wyoming and other universities in the area, because it's so much better that if they're homegrown and we can teach them how to produce the alpha that we talked about to manage it. That's 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 where we want to continue to grow. There are other funds out there have 100 people under on their staff. We have 10. So, we could continue to do this and take more of that money that we were referring to, and do it in-house, and hopefully cut the fees that we're paying to outside managers and grow the fund.
Wow. Well, I love ending on that note. I know we're a little bit over time, but thank you so much, Patrick, for sitting down with us. And please thank your staff for all the hard work they're doing to get the highest investment return. It really helps sustain our state and our services. Thanks everyone for spending our lunch hour. Wyoming Tax Facts and the Equality State Policy Center would like to thank our sponsor, the Wyoming Community Foundation, and our wonderful panelists today. I did want to say ESPC is also hosting our SHAPE training on January 19th and 20th. So if you're interested in learning how to get involved with the legislature, please visit equalitystate.org/SHAPE. I've put in the chat that link, Wyoming Tax Facts link, and the link to the Wyoming Community Foundation. Sue, if there's anything you'd like to add, I'll send it over to you.
Stay tuned for the recording of this webinar on the Equality State Policy Center website and also on Wyoming Tax Facts. It'll be available both places, along with the PowerPoint.
Yes. Yeah. Great. Thank you all.
Thank you.
Thanks, Patrick.
All
Thanks,
righty.
Marissa.
Bye.
Bye-bye.
Bye now.